Singtel has posted its smallest annual profit in 16 years. Intense competition in the Indian and Indonesian markets have limited its growth. Moving ahead, the telco is expecting its digitalisation efforts to generate more revenue. Here's Henry Yin with more.
Although marginally, Singtel reported better than expected scorecard for the financial year that ends in March. So its net profit dropped by 44% to 3.10 billion Sing dollars. That's better than market expectations. That was due to slowing demand at home and intense competition across the region, which put a cap on its net profit growth. In the meantime, its operating revenue up by 4% to 17.37 billion Sing dollars. Now, this was mainly supported by its better fourth quarter performance, and this was actually supported by resilient consumer business and digital business. Here in Singapore, Singtel is facing some structural issues with its revenue from higher margin traditional carrier business declining as consumers switch to cheaper data to make calls and send messages, and Singtel is not alone. For example, its competitor StarHub last year cut about 12% of its workforce, while M1 was taken private by its shareholders. And in its regional rival Malaysia, Axiata Group said earlier this month that was in talks with Norway's Telenor to combine their telecom business in South and Southeast Asia region to create a telecoms giant with a nearly 300 million customers. So for Singtel, it's recommending a final dividend of 10.7 cents per share. And looking ahead, Singtel CEO said it's pretty optimistic about its future here in Singapore with strong fundamentals, and is also likely to incubate 5G ecosystems so that it can ride the 5G development. And it's recommending a revenue growth by single digit, and it says its earnings before interest, tax and depreciation and amortization to be stable, and its capital expenditure are expected to be at 2.2 billion Sing dollars.